Hi everyone, have a pleasant day. This is Srimati, Assistant Professor, Dr. Ambedkar Global Law Institute, Tirupati. I am your auditing staff. Let us start with the syllabus auditing. In general, we say auditing means verification of books of accounts by the auditor which has been prepared by the accountant. Let us start with origin of auditing. So since everyone wants to know where it has originated. The practice of auditing accounts can be traced back to the early stages of civilization. The ancient Egyptians, Greeks, and the Romans used to get their public accounts scrutinized and audited by an independent official called auditor. The word audit was derived from the Latin word audire, which means to hear or to listen. Originally, the accounting parties were required to attend before the auditor who heard their accounts. Let us start with auditing in India. Kaudilya, in his Arthasastra, has mentioned about the auditing and accounting of state finances. He stated that all undertakings depend on finance. Hence, the foremost attention should be paid to the treasury. He also listed various kinds of frauds and embezzlement and prescribed punishments to deal with them. However, the growth of accounting profession in India has a recent development. Let us see that step by step. Joint Stock Companies Act 1857, the first company legislation in India. The Joint Stock Companies Act of 1857 contained the regulations for the annual audit of company accounts. Means these regulations were entirely optional as there was no legal obligation on the part of company for the submission of annual report. The next one is the Indian Companies Act 1913, in which for the first time the Act prescribed the qualifications for an auditor. Subsequently, the Indian Accountancy Board was established under the Auditors Certifies Rules 1932. On passing Chartered Accountants Act 1949, the entire regulation, control, management of the profession passed from the central government to the profession. Means they created a board called Institute of Chartered Accountants of India. The next, the Companies Act of 1956, which has been replaced by the Act of 1913. The subsequent amendments further elaborated the various provisions regarding the procedure of appointment of company auditors as well as their powers and the duties. At present, the Companies Act 2013 also state almost the same provisions in the Companies Act 1956. Auditing meaning. Majority of audit in the early days was confined to ascertain whether the accounting party had properly accounted all the receipts and payments on behalf of the owners. So, auditing means the scrutiny of books of accounts and the relative documentary evidence by an independent qualified person in order to ascertain the accuracy of the figures appearing therein. Means, so scrutiny of books of accounts with the relative documentary evidence and the accuracy of the figures in the books. That is about auditing. So, definition of auditing. There are a number of definitions given by the number of authors related to auditing. But if it is possible for you, you can please go through the Spicer and Pegler's definition for your examination point of view. And for understanding, let me start with the International Auditing Practices Committee defines auditing as the independent examination of financial information of any entity, whether profit oriented or not, or irrespective of size or legal form. When such an examination is considered with a view of expressing an opinion thereon. Next, we see the scope of audit. The following points merit consideration in regard to the scope of audit. The audit should be organized to cover adequately all aspects of the enterprise relevant to the financial statements being audited. What is financial statement? It is profit and loss account and balance sheet of a company. So hereafter, whenever we mention a financial statement, it means profit and loss account and the balance sheet. The next scope is to form an opinion on the financial statements. The auditor should be reasonably satisfied as to whether the information contained in the underlying accounts, records, and other source data is reliable and sufficient as the basis for the preparation of financial statement. In forming his opinion, the auditor should also decide whether the relevant information is properly disclosed in the financial statements, subject to the statutory requirements where applicable. The auditor assesses the reliability and sufficiency of the information contained in the underlying accounting records and the sources of data by making a study and evaluation of accounting systems and internal controls in the company. The next scope is the auditor determines whether the relevant information is properly disclosed in the financial statements. How it could be identified? By comparing the financial statements with the underlying accounting records and other source data to see whether they properly summarize the transactions, events recorded therein. Therein means in the books of accounts. And considering the judgments that the management has made in preparing the financial statements. The next scope is the auditor is not expected to perform the duties which fall outside the scope of his competence. For example, the professional skill required of an auditor does not include that the technical expert for determining the physical examination or physical condition of certain assets. The last scope, it's not a last scope, but it is the scope which constrains on the scope of audit of financial statement that impair the auditor's ability to express an unqualified opinion on such financial statement should be set out in his report, and the qualified opinion or disclaimer of opinion should be expressed as appropriate. Now you know that there is a relationship among bookkeeping, accountancy and auditing. Let us start with bookkeeping. Bookkeeping is the art of recording day-to-day transactions systematically in the books of accounts, as you did in your board exams, board classes, your journals, ledgers, strings, totaling and balancing of the ledger accounts under overall direction and supervision of an accountant. Accountancy. Accountancy begins where bookkeeping ends. The work of accountant is to check out arithmetical accuracy. The accountant prepared by the bookkeeper by preparing the trial balance. If any omission or error arising, it shall be rectified. Finally, the accountant has to prepare trading and profit and loss account and balance sheet, incorporating the necessary adjustments therein. Next, auditing. Auditing begins where accountancy ends. After the accountant has completed his work, an auditor is invited to verify the work done by accountant. The auditor is concerned with making an analytical and critical examination of books of accounts, checking and verification of the evidence is support of transactions appearing in the books of accounts. Next, we see the relationship of auditing and accountancy is close, but they are different. The main points of distinction between accountancy and auditing explained as follows. Difference is auditing is concerned with analytical and critical examination of financial records and statements, but in accountancy it is concerned with collection, classification and summarization and communication of financial data alone. The second difference is accountancy measures the business events in terms of profit or loss and communicates the financial condition to the business. But auditing, it reviews the measurement and communication of financial results and condition. The next point is the accountant is an employee of an enterprise entitled to a regular salaries. The auditor is an independent and professionally competent outsider whose service are hired for a fee. The next point is the accountant may or may not have a knowledge of audit techniques and procedures, but the auditor must know the principles and techniques of accounting. The accountant is not required to submit a report on the financial statements prepared by them, but the auditor is required to submit a report containing his opinion as to the truth and fairness of financial statements. The accountant, being an employee, ordinarily works on a permanent basis. The auditor has to be appointed every year. Accounting work is undertaken throughout the year. Generally, the auditing is taken up at the end of the year. The difference is on the basis of qualification, the accountant need not be a chartered accountant, but the auditor must be a chartered accountant. So we can conclude that sometimes the auditor may be required to perform the duties of accounting nature, such as preparation of financial statements and computation of taxable income, etc. In India, it is customary for the chartered accountants to be retained for this purpose. In today's class, we have seen the origin of auditing, the meaning of auditing, auditing in India, the definition of auditing, the scope of auditing, and the relationship between bookkeeping, auditing and accounting, and then finally the difference between auditing and accounting. Hope you enjoyed the class. Balance in your next class. Until then, bye. Thank you.